The biggest crash in the last 2 years did not come from the stock market. No, it came from the Treasury bond market. Treasury bonds are down over 53% in the last 2 years. But has it finally hit a bottom? And are we ready to see the mother of all rebounds in the Treasury bond market? And how can we profit massively from it? Find out in this video. Many retail investors, they focus on the recent stock market crashes. We had a crash in 2020 where the stock market crashed like 30%. In 2022, it crashed 30% as well. But what a lot of people don't realize is that the biggest crash in the last 2 years did not come from the stock market. It came from the government treasury bond market. So take a look at this chart, which is the TLT. The TLT is the Treasury Bond ETF. So you can buy this ETF to get exposure to the long-term Treasury bonds. And you can see that in the last 2 years, it had the biggest crash, biggest bear market in its entire history. US Treasury Bonds, the 20, 30-year bond, from the top has dropped 53% to the bottom right now. So what caused this crash? Well, interest rates. The Fed, the Federal Reserve, raised interest rates at the fastest pace in history in the last 2 years, and that is what caused bonds to crash. Now, always remember that bond price always moves the opposite, the inverse of interest rates. So when you buy bonds, remember, interest rates go up, bond price go down. Interest rates go down, bond price goes up. So because interest rates went up super fast, bonds collapsed in the last 2 years. In fact, this crash in long-term treasury bonds is what made Signature Bank as well as Silicon Valley Bank, that's why they went bust, because the value of the bonds they were holding went down 50, 60, 70% and they went bust. Now, a lot of people would think, but aren't bonds safe? I thought that bonds are safer than stocks. Yes, bonds, government bonds are very safe if you hold them to maturity. Now, remember when you buy a bond, and you hold it to maturity, you always get your money back, the face value of the bond back. But between now and maturity, the bond price fluctuates based on interest rates. Again, interest rates go up, bond price goes down. So if you sell the bond before maturity, you can lose a lot of money if interest rates go up. But if you can hold to maturity, then there's no risk, you always get your money back. Now the trouble would be these long-term bonds that mature in 20 to 30 years. And a lot of people, they say, I can't wait 30 years to mature, right? So they may be forced to sell their bonds because of liquidity issues, and that's how they get a massive 50, 60% loss. That's what caused the banks to go down. So the question right now is that, are we near or are we at the bottom of this bond crash? And if it is, how can we take advantage of it to profit from this rebound in bond prices? Now, in full disclosure, I already started to buy TLT 1 month ago. In fact, I entered right about there, and then I bought some more about 5 days ago. 5 days ago, somewhere about here. And all this was sent to my subscribers for the UIP, the Ultimate Investors Playbook. They got my notification. I was entering TLT both those times, but I'm looking to add even more in the next couple of weeks, depending on the price action. So why did I start to buy TLT? I'm here to explain to you how I read the technical analysis together with the fundamentals. Now, oftentimes when I enter a trade, now by the way, this TLT to me is not an investment. It's more of a trade, but it's not a short-term trade. It's more of a medium-term trade that I intend to hold for a couple of months. So I'm here to share with you my thought process. So the first reason why I entered TLT right here is because of the technical setup. Now, this I have to give credit to Khoo, who teaches the price action manipulation workshop, because this is something that he taught me, right? So those of you who have taken the price action manipulation course, you will know that this pattern over here, what pattern is this called? This is called a 4-strike pattern. So a 4-strike pattern is a very powerful bullish reversal pattern. So this is a 4-strike pattern taught by Khoo, and I saw it and said, oh, okay, it's going to rebound, all right? And this 4-strike pattern happened at a historical long-term support level. Now you can't see it on the daily candles, but if I switch it to monthly candles, let me show you. There. So if you go out to the long term, that's why it's important that when you study charts of stocks or ETFs, you have to look at different time frames. I don't just look at a daily time frame, I look at the weekly time frame, I look at the monthly time frame. I look at 10 years, 5 years, 3 years, multiple time frames. So you can see that on the long-term time frame, there is a very strong support level here. Can you see that? Very strong support level here. And after it dropped 53%, it hit that very long-term support level at $82. So number one, it hit a strong support level, but we need a candlestick pattern to tell us that it's going to reverse. And we had, again, this 4-strike pattern that is taught in the price action manipulation workshop over there, right? So that was the reason I entered the first time over there. And then I entered some more a few days ago, because as I entered here and the price started to go up, the price started to build momentum, right? And it now managed to cross above the 50 moving average. So when something crosses above the 50 moving average, it's an indication that it's starting to build into an uptrend. Now, I have to say that it is not yet confirmed on an uptrend. To confirm the short-term uptrend, the 20 EMA, the red line, has to cross above the 40 EMA. That has not happened yet. So, but I like to get in early before the confirmation of the uptrend. Then I get in at a very low price. Then when it confirms the short-term uptrend, I add even more. Then when it confirms the medium-term trend, where the 50 moving average, blue line, crosses above the 150 moving average, and then the price crosses above the 200-day moving average, then I would add even more. But by that time, the price would have gone up a lot already, right? That's why I like to get in early using a lot of these reversal patterns that we learn in the different courses that we teach in Piranha Profits. So I didn't just enter this purely based on a technical setup. I entered this because of fundamental reasons as well. So remember that these TLT is affected by interest rates, right? So about a month ago, I felt that interest rates had already peaked, and I talked a lot about this in my webinars, that I felt that the Fed was no longer going to raise interest rates. They were at the end of their interest rate hike cycle, and I also felt that inflation had peaked and inflation was going to come down. So once I think inflation is going to come down, the Fed will not raise rates anymore, I felt that the long-term interest rate will come down, and they have. And because interest rates come down, bonds go up. So that was a fundamental reason that I entered at this point of time. Now, when I entered this TLT trade, I did not actually buy the underlying shares. I used an options strategy known as a bullish synthetic spread. And I'm going to explain to you why I did that and how I create a bullish synthetic spread. So you can see my two notifications that went out to my subscribers. The first was back on the 25th of October, again about a month ago, where I said that I'm entering the TLT bullish synthetic spread with a stop loss at $82. Now again, like I said, this is not an investment, it's a trade. It's a medium-term trade, so with a trade, I always have a stop loss, right? And then I re-entered another round a couple of days ago on the 16th of November, which I sent to my subscribers on UIP, and I said I'm adding more TLT with a new stop loss at $86. So as I'm adding more and more, I would raise my stop loss to protect my earlier profits, as well as create a new stop loss for the future addition to this trade. So over here, you can see my TLT trade. Again, I did not buy the underlying shares. I'll explain why later on. I use a bullish synthetic spread strategy using options. And since I entered it, I'm up about 7%. So in this account, you can see I'm up about over $5,000 in profit. So it's still a very small profit. I'm looking to get a lot more profit as the price keeps going up and I keep adding more and more to the position. So where's my profit target for this trade? Well, I don't really have a profit target because I will stay in the trade as long as the bond prices keep on rebounding and as long as it reverses into a new uptrend. Now, but having said that, I do have some intermediate targets that if the price happens to reverse back down, then I will just take my profits and just run. So right now, based on the technical charts, you can see my intermediate target is actually about $99. Why $99? Because you can see this was a previous level of support that could become resistance, and that also coincides with the 50 moving average on the weekly candles, right? So I'm watching the price action. It should get up to at least $99, and I'm going to see what happens. If it gets rejected and reverses down, then I'm going to get out the trade and just take whatever profits I have. But if it can break above the 50 moving average on weekly candles, that means a very strong uptrend is going to start, and then I could ride it all the way back up, which could be a huge return. So I'm going to watch and wait to see how the price action plays out. Now, that's based on the technical analysis. Based on fundamentals, now remember, what will cause the treasury bond prices to keep going up? Ultimately, it depends on the treasury yield or long-term interest rates. So if you take a look at the 10-year treasury yield, the good news is that it's been coming down. It has broken the uptrend. It looks like it's coming down. This is the 10-year treasury yield. Okay, and if you look at it on weekly candles, this is what it looks like. All right, so it was on a very strong uptrend over here. So again, remember, this is the 10-year treasury yield or the long-term interest rate. So in other words, when this goes up, bond price will go down. When this goes down, bond price goes up. Is the opposite. Yeah. So as this was going up, this long-term interest rate was going up, TLT went down. But now it looks like it has broken this uptrend, and if it continues to go down, then the TLT will continue to rebound. Now, what affects this 10-year treasury yield? It's affected ultimately by inflation. Now, the long-term interest rate, which is the 10-year yield, is always based on inflation plus about 1.5%. It's roughly like that. So in other words, if right now inflation is still about 3%, right? Right now inflation is about 3.5%. So right now, the 10-year yield should be at 3.5 plus 1.5, right? So the 10-year yield should be at 5%. But the market is really pricing in the fact that inflation is coming down over the next few quarters, down to 3% inflation, right? And then down to 2% inflation. So if inflation continues to go down, then this guy will go down. But of course, if inflation flares up again, then this guy will go up and TLT will go down. So it all depends on inflation. So my belief is that I think inflation has come down, but again, I could be wrong. I can't predict the future. If inflation goes back up, then of course, TLT could go back down again. And that's why my stop losses are in place. By the way, one advantage of holding the TLT, which is the long-term bond ETF, is that it's a great hedge against recessions. It hedges your stock portfolio against recession. So historically, whenever there's a recession, people get scared. Oh my God, it's a recession. And they buy bonds because they feel safe in bonds, and that's when TLT goes up. So if you think a recession is coming next year, which I don't know, I can't predict, but if you think there's going to be a bad recession, then TLT could be great because that will fly to the moon if a recession hits. Now take a look at history and you can see what I'm talking about. So during the 2020 recession, the COVID recession, what happened? The stock market dropped, right? But what went up? The TLT, the long-term bond ETF went up, whoa, right? So when the bonds go up, they offset your stocks dropping temporarily. And before 2020, what was the recession before that? Well, we have to go back to the great financial crisis. There, same thing. So during the financial crisis, stock market dropped and TLT went up, right? Bonds always go up in a recession. Okay, the next thing is I'd like to share with you a very powerful options strategy that I use called the bullish synthetic spread. Now, you may say, Adam, why don't you just buy the shares? Now, of course, I could do that. The only thing is that if I buy the shares, it takes up a lot of capital. Whereas if I use a bullish synthetic spread, it uses less than 20% of the capital required to control the same number of shares. So in other words, it is more capital efficient, if you will. All right. So let me give you an example of what I'm talking about. So let's imagine I want to buy 100 shares of TLT. And right, what's the price of TLT right now? it is right now at $90, right? $90.59. So if I were to buy 100 shares, how much would it cost me? It will cost me $9,000, right? About $9,000, which is okay, all right? But by using a bullish synthetic spread, it is equivalent, the profit and loss is equivalent to owning 100 shares, but instead of forking out 9,000, it only requires me to have 2,000 to have the same 100 shares profit and loss exposure. So it uses a lot less capital for the same position that I'm in, right? So what is a bullish synthetic spread? Let me just explain. Let me write it down, right? So bullish synthetic spread is an advanced options strategy that we teach in detail in our options trading course. Oh, by the way, all our courses and mentorship playbooks are going for up to 75% off right now during this black market period, during the Black Friday sale that happens once a year. So go on to piranhaprofits.com to grab all the courses and mentorship programs at up to 75% off. This is where we teach all these strategies in detail. So this is just one of these many powerful strategies, right? So bullish synthetic spread. What the heck does this strategy do? Okay. So in a bullish synthetic spread, it involves buying a call option, right? Buying a call option and selling a put option at the same time, at the same strike price. Now, of course, if you don't understand options, please go learn the basics of options in my free YouTube videos, right? So I'm assuming that you understand the basics of options, right? So we buy a call option and sell a put option at the same strike price and on the same expiry date. That is called a bullish synthetic spread. And when you do this, the profit and loss is equivalent to owning 100 shares. It's exactly the same thing, all right? Now, some of you may say, Adam, why don't you buy a call option? Now the trouble is when you buy a call option, you have to pay a big premium to buy the call option. And when you buy a call option, it decays. There's time value. So every day you're losing value until it will expire worthless if the price doesn't go up fast enough or enough to cover the cost of the call. That's why I don't like to buy call options, because 80% of options expire worthless, right? So when you buy a call option, you make money if the price goes up fast enough and if the price goes up significantly enough to cover the cost of the call option. But if you buy a call option and the price goes up very slowly or goes up a bit, then your call will lose value and you end up losing money, even if the price goes up later, right? That's why I hate buying call options, because it's a losing game, right? So what I like to do is I like to buy a call option and sell a put option at the same time. Why? Remember, when you buy a call option, you have to pay the premium to buy the call option, right? But when you sell a put option, you collect premium. So the premium you get from selling the put option pays for the call option. So net, it's a free trade. It's a free trade. You pay nothing. In fact, most of the time, not only do I pay nothing, I get paid a credit to enter the trade. Okay? Pretty cool. So that's why I love the bullish synthetic spread. Now, not to say that you can't lose money on the trade. Of course, you can lose money if the price goes down, right? But the cost of the trade is zero, in a sense there's no premium to be paid, all right? So let me give you an example of how I would enter it right now if I wanted to enter it. Now, this is not a recommendation for you to enter this. I'm just sharing it for educational purposes, right? Okay. So if I wanted to enter a bullish synthetic spread right now, this is what I'm going to do. I will open up my trade tab, okay? And then I will then choose a date to expiration. Now, it doesn't really matter which date you choose because it's a free trade, right? Because remember, the premium you get from the put will pay for the call, so it's free anyway. So you can choose whatever date to expiration, it's still free, okay? Usually, I like to choose about at least 60 to 80 days, so that I don't have to roll it over that quickly. So let me just choose 59 days, right? Now I could choose 87 as well, doesn't really matter, but let's choose the one that expires on the 19th of January. Let's open it up. Okay, there we go, right? So right now, TLT is selling at $90.59. So I'm gonna buy a call at the market, okay, or at the money, and sell a put at the same strike price, okay? So what's closest to $90.59? The closest would be $91, all right? So I'm gonna buy a call here. So I'm gonna click here, buy the call, and sell the put at 91 as well. There we are, okay? So this is one contract. I'm buying a call at 91 strike and selling a put at 91 strike. So net is a free trade. In fact, not only is it free, but I get paid a 16 cents credit to enter the trade. Not bad. I'm getting paid to enter this trade. Now, one contract is 100 shares, right? So 16 cents times 100, I'm getting paid $16 to enter the trade. So what does the profit and loss graph look like? This is what it looks like. Let me open this up. There we are. Okay, so this is the profit and loss graph. And the profit and loss graph is equivalent to owning 100 shares. No difference. Same as owning 100 shares without paying any premium. So you can see that right now, what's the price of TLT? There, $90.78, right? Now, on the y-axis, you can see that's a zero line. Anything above that is profit. Anything below that is loss, right? So that's the y-axis. On the x-axis is the price of the stock or the ETF. So of course, after you enter the trade, TLT could go up or TLT could go down, right? Now, if it goes down, do you lose money? Of course you lose money. So for example, you can see that if it drops to, let's say, $86, right? If you buy, it drops to $86, how much do you lose? Well, you put your mouse here and you can see the box, it tells you your loss per contract, right? So you can see if it drops to here, then you will lose 400 and, let's see, it's a bit small, $481, right? 481. Okay, you will lose $481 if it drops to $86, right? And that is exactly the same if you buy 100 shares. If you bought 100 shares, it drops to 86, you will also lose 481. So no difference, it's the same thing, right? Now, what if TLT goes to $99, which is my target? Now, again, it may or may not get there. I can't predict the future. It's just a trade, right? If it gets to $99, then my profit will be, look at the box over here, my profit will be $902. Okay, $902 over here. Now, again, with any trade, it's important to have a stop loss. Now, this is not an automatic stop loss, it's a mental stop loss. In other words, you have to tell yourself at what point are you going to cut loss. So if you tell yourself that, okay, I'm prepared to lose $481, then the moment the price gets to there, you have to close the trade. So in other words, you have to buy back the put you sold and sell the call that you bought. And you close it as one trade. And of course, all this is taught in detail in the options trading course under bullish synthetic spread. So this is how I enter the trade. Now again, you may say, why don't I just buy 100 shares? Why do I do this, right? Because again, notice that by using this technique of this synthetic spread, notice that what is my buying capital required, right? The buying power required that's used in my account is only $2,000, right? Versus if I bought 100 shares, I have to use 9,000, but now I only use 2,000. So I only use 20% of the required capital. Yeah. Now, of course, for you to do this, you need to have a margin account with a broker. So I hope it's been interesting for you to learn the bullish synthetic spread. And again, this is just one of many, many strategies that you can learn in the options trading course. Now, remember to head over to piranhaprofits.com and take advantage of the black market sale that happens once a year, where most of our courses and mentorship playbooks are going for up to 75% off. I'll see you guys soon in the community.